only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint. You're watching the fine print. Fortis Healthcare is facing a takeover battle from 5 bidders, and just today, the board picked the best suitor for the company. But it's not the only resolution that the shareholders of the company have to vote on. They have to also decide whether the 4 existing independent directors on Fortis's board should be removed. This resolution was put forth by 3 minority shareholders of Fortis last month. With a combined shareholding of 12%, Jupiter Asset Management and Eastbridge Group have proposed that 4 independent directors be removed from Fortis's board since they failed to meet the expected levels of corporate governance. And here's where things get interesting. Just this week, in perhaps a first for Indian boards, these 4 directors took to writing a letter addressing the company's shareholders, urging them to not vote for their removal. They've argued that a complete change of the entire board at this point will lead to more turbulence and ambiguity for the company as well as its management. Making a case against their removal, the directors have pointed out that they are best placed to leading the company out of its current problems and have explained why they only considered the binding bids for Fortis Healthcare. So, should this letter by the 4 independent directors be viewed as a positive development in the larger corporate governance debate, and how should the shareholders vote? To answer that, I have with me Hetal Dalal, Chief Operating Officer at proxy advisory firm IIAS and well-known independent director Nawshir Mirza. Mr. Mirza, Hetal, welcome to the fine print. Mr. Mirza, when was the last time you saw independent directors talk to shareholders directly in this fashion, and what do you make of the decision of these 4 directors to write this letter?
Aswini, I can't recall when this last happened. I certainly can't recall that. But I do think that what they have done is a good thing, and they've done it a little late. They ought to have been in communication, or at least the company should have been in communication much earlier with its stakeholders. But even at this late stage, at least they have taken the opportunity to communicate their views to stakeholders, including the shareholders.
Hetal, in the large universe of companies that you all cover at IIAS, have you ever come across independent directors reaching out to shareholders to tell their side of the story?
No, not that we can recall. I think it's also not very often that shareholders bring up a resolution to remove the board members. But having said so, the fact that you have now a set of directors who made a joint representation to, a set of board members making a joint representation to shareholders also shows the increasing power of shareholders in being able to bring about change. And to that extent, we think this is a very, very positive view. I agree with Mr. Mirza that this should have been, the communication should have been far more open and transparent much earlier on the process. But notwithstanding, the fact that they've actually put out something is indeed a positive step as far as governance in India is concerned.
Mr. Mirza, how are you viewing this decision by the board to write this letter? Is this a genuine effort to help shareholders take an informed decision, or are we to view it as their attempt to continue on the company's board?
No, I think they have been quite transparent in the way they have expressed themselves and explained their point of view. My concern is a little greater. I think they've written it very well, and they've started with the first point. I have a copy of this somewhere, but never mind where that is. The first point on what they address is what has, in their opinion, provoked the requisitionists to requisition for their removal. And I think there they have ducked the real issue, and the requisitionists have been pretty cryptic in their requisition for removal. But I think the underlying point the requisitionists are making is not just what is now transpiring or unfolding. The underlying point the requisitionists are expressing or have a concern about is what was the culture within the organization that permitted certain things to allegedly happen. We don't know whether they really happened, but there are allegations of serious wrongdoing, of siphoning out funds. And what was the culture that permitted for this to happen without the independent directors knowing? Was there not a whistleblowing process? Didn't the top management ring up the independent directors and say, Do you know, sir, we have been asked to transfer money into certain accounts which we are not very certain, very confident about. So that is the underlying concern, that if these are the kind of people who permitted that kind of culture to prevail in the organization, are they the right people to continue to be in control of the business?
Okay, Hetal, what do you make of the contents of this letter? You put out at IIAS several reports tracking what's the manner in which the company's board has been functioning. Do you think that the concerns that the 3 minority shareholders had raised in their requisition, are those concerns adequately answered by the board?
No, I think the board has, or the members of the board have put out their position, but they haven't answered the real questions. I think one is, of course, the fact that there is these alleged allegations about siphoning of funds, and while they have said that they've got Luthra and they've appointed Grant Thornton to run an investigation, that's a subsequent issue. The other piece I think that the investors are also not happy about is the entire process in which which the board has followed right up till now in determining which bid will actually be accepted. And I think the lack of transparency around this entire process and the fact that the lack of communication, the lack of transparency, and effectively expecting bidders to make a bid without even providing them an opportunity for due diligence are concerns which investors have. And it's not about what the final outcome is. You're always questioning whether, given the process, was it a fair process, did everybody get equal opportunity, and then you come to a conclusion saying, fine, this was the outcome of a fair process. Investors today are just questioning the entire process as well, which is being followed.
Okay, do you also believe that it remains a concern for investors that that these directors were appointed by the erstwhile promoters who are no longer in control, and perhaps it's this seemingly lack of independence that the minority investors might be questioning?
Of course, given if you look at it, you have some board members who are on the board of SRL, where the brothers are still on the same board. The fact that all of this has happened, they've had long associations with the existing promoters or the group companies. Even the new appointees which have come in have had some association with the group and the family members running Fortis or promoters of Fortis, I think is an element of concern. And this element becomes actually far stronger and far sharper given the process which has been run, which is actually reinforcing their concern.
What would you have liked the board to do in terms of the process? They've made their case that, look, we only considered the binding bids because we wanted certain degree of certainty that the cash will in fact come into the company. Are those justifications not good enough?
The fact that they need fund infusion is not in dispute. The fact that they need liquidity support is also not in dispute, and therefore the fact that they need to make a decision quickly is not in dispute. I think the issue is really, did you allow all bidders the same opportunity to give in a bid? You have one set of bidders which did a due diligence which is complete. You have another set of bidders which did a due diligence which was up to last year, and you have a third set of bidders which didn't do any of the due diligence. To expect that bidders will give you a bid without due diligence, given the series of allegations which are already there, the series of investigations that the promoters and the group is already under, and the fact that the auditors have raised concerns and are not willing to really certify to the sanity of the accounts, is reason enough for the board to provide them opportunity to at least ask the relevant questions. Now, given the fact that there is one bidder which has done a due diligence, this is clearly an outcome of that particular due diligence. All the board really needed to do was create an information docket which they give to the expected bidders, or they create a data room when they give them 1 or 2 days to really get a sense of where the issues are and how they are therefore going to price. From where they started, let's look at the first Manipal TPG bid to where they are now. They've already had a long run in terms of time, right? It's almost been a month or maybe a little more. So to therefore then hold a view saying immediate liquidity was a concern and therefore we followed this process is a relatively weak argument.
Okay, Mr. Mirza, do you agree with what Hetal is saying, that the board should have done all of this to give a fair shot to all the bidders who were interested in Fortis, and this lack of a transparent process is then a valid ground for these minority shareholders to question the independence of these directors?
Yeah, I think, Payaswini, 2-3 things. Let me take the very last point you just said, independence of the directors. Here, whom do we want the independent directors to be independent of? Because there are 5 bidders. And I am presuming that all the independent directors are independent of those 5 bidders. They have no particular leaning towards one or the other. I'm presuming that. I don't know if it's a fact. So independence, the issue is vis-a-vis the 2 Singh brothers. I don't know whether that has a relevance to the topic we are talking about. So that's point number 1. Point number 2, I entirely agree with Hetal. See, first of all, I'm surprised that people are willing to bid for this company without doing a due diligence. That really astonishes me, because it means you're going out in a very risky position, especially in this company. But if I was a person who was putting in a bid like that without diligence, I would build in an enormous cushion in the price I am going to quote. So really, if I am going to take bids without sufficient diligence being permitted to the buyer, then all I am doing is hurting myself, because then the prospective buyers are going to put in those cushions that God knows what else is hidden there. We know that there is a claim, alleged 473 crores. We know that. So, okay, we'll consider that into account. We know this, we know that, we know the other. But what else is there? We don't know. So, coming back to the exact point Hetal made, the sellers, that is the company, Fortis, should have done a seller's due diligence, which is a process that's followed. They should have appointed an independent firm to conduct a due diligence and put that report in front of all the prospective buyers. That's the least they could have done, because there would then be an independent entity making a statement that these are the exposures and the risks according to our work. You can do your own diligence and you may uncover something more, but we are at least giving you assurance that even your due diligence is going to is unlikely to cover anything beyond what we are representing to you. But they haven't done that either.
Hetal, the 3 minority shareholders have asked for removal of these directors on grounds that they have failed to meet the expected levels of corporate governance, and that they have lost confidence in the suitability and independence of these directors, which I may point out were appointed by the erstwhile promoters who have negligible control in the company now. The board, on the other hand, has made its arguments in the letter that they did what was best for the company. How should shareholders assess this resolution then for their removal?
I think shareholders need to ask themselves whether they fundamentally believe this is the best offer on the table. You have a set of bidders which have come in. Some have a very good financial, some are giving you a better financial offer, some are giving you a better strategic fit into the business model. I think shareholders need to ask themselves whether this is the best decision which the board could have come to. But leave aside, simply the outcome of the entire process. I think there's just a lack of transparency around how they've come to this entire process. What was the advice that the financial advisors gave them? Did they actually recommend that this is the best offer? Why is it, what is the consideration that they have? And it cannot be as simplistic as immediate liquidity, because all the offers on the table were willing to give them some bit of some piece of it in a binding form. The third thing I think shareholders should indeed ask themselves is the board acting in the interest of all shareholders? If they actually were acting in the interest of all shareholders, the bidding process would have had far more real numbers attached to it, rather than asking the bidders to really bid in the blind, which is essentially what they did by making them bid without a due diligence process. So all in all, I think the degree of comfort that they have in terms of this entire process should be a determinant of whether they are likely to support the removal of the existing board members or not.
Okay, Mr. Mirza, if you were a shareholder in Fortis Healthcare, how would you vote on this resolution?
Well, to start with, I wouldn't have bought shares in a company run by, promoted by certain people. So I wouldn't have been a shareholder, and I'm not.
I said
but
if so.
were I in the unfortunate position of being one, yeah, I know. The real issue in front of me would be, is the new regime going to be likely to be better than the old one? What options does the new regime have vis-a-vis this particular transaction in front of us? Would they be able to back out of it? I presume they would. And do you think that by bringing in a new set of directors and chucking out the old, they are likely then to reach a conclusion that's different from the one that has been reached by this group of people yesterday, which is the Munjal Burman bid? So there are, ultimately I have to decide, going from here forward, what is my assessment? Which of the two are likely to be better for me? There is certainly a lot to be argued for retaining the old lot, because they know the business. For whatever it is, whatever things have happened, they are today well aware of what the issues are, and they will therefore be in the best position to resolve them if they had the right intentions. And that is the key to it. The new people coming in, we don't know. These are three individuals who have good records, but we don't know how well they will fit into this company speedily. The fact is, they will fit in, give a few months, but will they be able to fit in right away, take charge and make the right decisions? Because this company needs certain urgent decisions. It doesn't have the luxury of getting in a very fresh board, which takes 8 or 9 months to figure out what is what. And we don't want these directors then to be influenced by the 12% requisitionists, because the 12% requisitionists presumably are well-intentioned, but they may be making their own mistakes. So we want the board to act independently. So I think the shareholders have to think, is option A likely to be better than option B? That's not a judgment which I can guide them into. Each has to reach their own conclusions, looking at what the pros and cons are. Take the Munjal Burman bid. The existing shareholders are stuck unless they sell into the stock market. They're not going to get a choice option of exiting by an offer from the entrants. And certain other things are there in this bid which are not in the others. Indeed, going further and to add to what Hetal said, I have not seen something, maybe there is, explaining why they chose Munjal Burman over the other four. What was the reason why this looked the best offer yesterday to them?
But I'm not sure, sir, this was a consensus decision. Seemed like from the press conference that the majority of the board members voted on that decision. Yes.
It says majority. Correct. There wasn't a consensus. It says by majority.
Well, in the interest of corporate governance, the current board should put out the reasons as to why the Munjal Burman bid was selected by them as the winning bid. And as to the resolution of removing these 4 independent directors, we'll know the outcome of that on May 22nd. That's when the proposal will be put to vote. Hetal, Mr. Mirza, thank you for joining us with your views on the fine print today. Moving on, 1 circular and 3 casualties. I'm talking about SEBI's recent circular on Know Your Customer or KYC requirements for foreign portfolio investors or FPIs. The circular has FPIs, NRIs and India-based investment managers worried. Here's why.
Non-resident Indians or NRIs can invest in Indian equities either directly or take the foreign portfolio investor or FPI route. FPIs need to register with SEBI and are divided into 3 categories based on their risk profile and the consequent KYC requirements. Category 1 includes government entities. Category 2 includes regulated broad-based funds. And endowments, charitable societies, foundations, family offices fall under Category 3. So far, NRIs generally invested through Category 2 FPI funds and were mandated to keep their shareholding in such funds below 50%.
We have seen a lot of back and forth both in the FDI policy and the FPI regulations with respect to how NRIs are treated, because SEBI keeps changing the regulations depending on NRIs pushing for liberalization of the rules versus the regulator feeling that the route is being abused through money laundering and round-tripping issues that SEBI has concerns with.
The NRIs could also basically make investments through the FDI route, but I believe there are multiple reasons why they would have chosen to basically still make investments through FPI. Is not everyone has investment acumen. It's much more easy to basically make investments, divestments. It's much more easier not to get registered as an FPI per se, not having bank or securities accounts. So there are benefits, and maybe that's the reason people still basically prefer to make investments through offshore funds, get exposure in various jurisdictions, because offshore funds may not be investing only in India, and that's how the NRI investments may be coming into India.
And it's these NRIs that are the first casualty of the recent SEBI circular. The regulator has clarified that NRIs can no longer be beneficial owners of FPIs. Beneficial ownership for FPI funds structured as companies or trust has been defined to mean 25% interest and control. The threshold for identifying beneficial ownership in FPI funds structured as partnership firms is 15%. Existing FPI funds where NRIs are beneficial owners have been directed to either change their structure or close their position in the Indian market within 6 months.
It's a little far-reaching, because if money laundering is the concern, then it's really person who has control that you should be looking at for a test. So let's say it's a discretionary trust where the investment manager decides how to make the investment. It should really not matter what the ownership structure is, as long as the owners are not making decisions vis-a-vis the investments into India.
Now what they've done is effectively they've said that the beneficial owner of the FPI cannot be an NRI. And the beneficial owner effectively would be subject to various parameters, like either it depends upon the kind of the structure of the FPI entity, and depending on the structure, the threshold could be 25%, 15%. If it's from a high risk jurisdiction, it could be 10%. On top of that, does the NRI have control, doesn't have control? So now there are subjective, I would say, thresholds provided for the NRIs to make investments through FPIs. And yes, there would be an impact, but I would say like the genuine NRI investors would effectively be in making investments through multiple FPI investments, multiple FPI funds, such that they are less than the beneficial ownership thresholds in each of them.
SEBI is saying, individually or in aggregate, the NRIs cannot be majority, becomes extremely restrictive, because if the reason NRIs come through this route is, let's say they're investing in a fund, then that gets an FPI license to invest into India. They don't want to take direct exposure into India, and they don't want to directly take these decisions. So they provide their money to a fund. So you could have a fund manager targeting NRIs to raise equity to invest into India, which is a easier asset class to direct your marketing to, because they understand India. It then becomes very restrictive when you say majority of that can't be NRI, especially if it's broad-based.
The second casualty of SEBI's circular are FPIs. FPIs are currently allowed to invest up to 10% in a listed Indian company. SEBI has now said that this investment limit of FPIs will be clubbed if they have the same beneficial owner. This means if NRI X is a beneficial owner in two unrelated FPI funds A and B, then A and B will be considered group entities. And if combined, they breach the 10% limit in a listed Indian company, it will be treated as foreign direct investment, and one of them will have to sell within 5 days for their investment to be treated as FPI.
One thing is with respect to identification of a beneficial owner, giving supporting documents of the beneficial owner, and there I don't think so the industry is generally concerned about giving that information. But then linking that to an aggregation of investments, and just to give an example, a person in a corporate structure who controls the entity is the beneficial owner, even if he doesn't have any ownership interest. And effectively, like entities like the manager, and because the manager has investment management decisions. So are we then saying the same investment manager having multiple funds where there is no actual economic ownership overlap across those funds have to be aggregated only because you have a common investment manager? And if that is the case, then there will be quite a lot of funds where they have a common manager, where they will basically effectively breach more than 10%. And then they'll have to decide whether you continue as an FPI investment or as an FDI investment or sell down. So it is having a far reaching impact.
That 10% limit under the KYC circular, SEBI has clarified they will apply the same test that has been laid down for determining whether or not an NRI is in majority control or not, will also apply for the limits, calculation of the limits under the FPI regulations. So, for example, if they determine a particular NRI is owning 25% through a company structure of an FPI as well as another FPI, then they will look through and see the beneficial ownership, the 25%, and say that these are group companies because you've got control now of one NRI on both these entities. And then, if that test is met, then both those FPIs together can hold only 10% in aggregate of an Indian entity, listed entity. And if they already hold more than that, then they will have to divest, or it will be considered FDI for the purposes of Indian regulations.
The SEBI circular doesn't just have NRIs and FPIs worried. Indian-based investment managers have been affected too, since they can no longer be beneficial owners of FPIs. Experts point out that many investment managers based in India set up offshore funds to attract NRI money, control them, and invest some of their own funds to show that they too have their skin in the game.
We definitely know of certain structures where Indian-owned managers had specifically gone to SEBI for approval to set up, NRI-owned investment managers offshore that were taking the category 2 FPI license to manage then category 2 FPIs. And when you set up such structures, SEBI has said that if you're a non-investing FPI, then you can be NRI managed and controlled. But it's very typical for any fund investor to require the investment manager to take some, have some skin in the game. So, put in some of their own money, some own investment. And SEBI has not provided a threshold. So, even if, let's say, I put in a 5% equity into the fund that has taken the registration as an FPI manager, as an FPI, and I'm the manager for it, then in that circumstance, that 5% will also trigger a violation of these regulations. And this is despite them having gone to SEBI and taken approval for these structures.
In case if the Indian resident entities are having any sort of a control aspect or any ownership aspects, and hence they are the beneficial owners, as per the circular, they need to basically wind it up or basically change the structure. But since this have been there in place since the FII regime, I would believe, and they were subject to specific approvals given by the regulators, maybe I guess each of these houses would make representations to the regulators on the kosherness of their structures way forward.
Well, we hear that custodians and lawyers are talking to SEBI to see clarity on all these aspects. But if the regulator maintains its stance, FPIs, NRIs and India-based investment managers will need to act soon. That's all there is on this week's show. Do send us your feedback. Thanks so much for watching. We'll see you next week.
Karnataka is an unforgiving state. It has rarely re-elected a government. But can the Congress afford to lose this one? The BJP is playing every card to recreate the 2014 magic. Will Karnataka be Rahul Gandhi's coming of age, or will we move towards a Congress Mukt Bharat? Watch Battleground Karnataka only on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
President Trump is somewhat embarrassed by the special counsel's investigation into Russian meddling in the 2016 election. Kelly tells National Public Radio the probe, quote, may not be a cloud over the White House, but it does get discussed. Kelly also says he has a close relationship with the president and has never considered leaving the administration. In Russia, intelligence agencies prevented a terror attack on the giant Victory Day parade in Moscow that marked the end of World War II. A Russian diplomat says several terror groups in Siberia had stockpiled weapons for the attack. Russian President Vladimir Putin attended the parade with Israeli Prime Minister Benjamin Netanyahu. Mail volume across the U.S. continues to drop, and that's taking a toll on the Postal Service. The USPS reported another quarterly loss today. The Postal Service says costs of its health care and pension obligations outweighed strong gains in package deliveries. The Postal Service has called for greater freedom to raise stamp prices to help cover costs. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
From Bloomberg World Headquarters in New York, I'm Sherry Yan.
And live in Toronto, I'm Amanda Lang. Welcome to Bloomberg Markets. We're now joined by both our Bloomberg NBN and Bloomberg audiences.
Here are the top stories we're following from around the world. U.S. stocks mixed today, but major benchmarks still on track for the best week in 2 months. President Trump calls out American auto execs, saying millions of more cars should be built in the U.S. We speak to the CEO of Magna International, one of the world's largest automotive suppliers. And drug pricing also on the president's agenda today. He's set to announce a plan to fight ballooning healthcare costs in the U.S. Amanda, let's start it off with a quick check of the major averages. We are seeing U.S. stocks mixed at the moment. The Dow, though, gaining for 7th consecutive session. This would be the longest winning streak since November of last year. But the tech is dragging down a little bit, and the broader market underperforming the broader market. Take a look at biotech, the biotech index, which is gaining ground today. Of course, investors keeping a close eye on drug companies and PBMs ahead of President Trump's speech on drug prices today, although his remarks seem to be already priced in. The healthcare index on the S&P 500 also gaining ground for a 3rd consecutive session, while pharma stocks are also up, but also good to note that this group has been underperforming the market, so it's now trading at a 5-year low of less than 14 times forward earnings, Amanda.
And Sherry, I want to take you inside the terminal here. Of course, President Trump is meeting with U.S. automakers, global automakers in the U.S., urging them to bring production back to the United States. What you're looking here is the capacity and production of Mexico. It was really on track to hit 5 million in production of vehicles in 2018. Just by way of comparison, last year the U.S. produced 11 million vehicles, Canada 2 million. So 5 makes Mexico a player here. We'll see what kind of assurances the president tries to wring out of automakers about where they produce these vehicles. vehicles. And as we mentioned, as President Trump meets with the 10 major automakers at the White House today, part of that meeting really was addressing the ongoing NAFTA discussion, saying, quote, "We'll see what happens." He restated his belief that this is a terrible deal. So how does all of this affect NAFTA, of course, affect the auto industry? Well, Don Walker is CEO of Magna International. That's a major parts supplier, biggest auto supplier in North America, a huge player globally. You're watching this with huge interest. When a U.S. auto manufacturer pulls production out of Mexico and moves it back to the States, I imagine you have some logistical business to do, because you're located in Mexico, too, to supply them there. What does it mean to you?
Well, I think the big picture here is, and everybody understands this, is we need to keep NAFTA as a trading region against the competitors, say Europe and Asia, competitive. Because if we do make it too expensive, then automakers will produce around the world. And each of those three areas have to have a low-cost location, and that's Mexico. So to the extent that an automaker moves the assembly plant, over time, a bulk of the big parts will move as well. So we have over 70,000 people across NAFTA. It's very important that they get this right.
I've been in your plant in Mexico. It's very impressive. I know it's one of your most productive and efficient plants globally. The workers there make a fraction of what your Canadian and U.S. workers make. On the table here is this discussion point about a certain percentage of a vehicle being made by workers earning at least $16 an hour. You must look at that and shiver a little bit, because that would hit your bottom line.
No, as a Canadian, I think the objective here that people are talking about is not that the Mexican wages are too low. It's that they don't want the Mexican assembly plants to go there. So if they can come up with some way that makes it less interesting for automakers to put the assembly plants there, that's their objective. If they raise all of the wages, that means all of the really high labor content that nobody else would do here will all move back to Asia, which is a lose-lose. So I think the objective, which they're trying to come up with, is something that will make it more attractive. Don't forget, Mexico has free trade with lots of countries, so it's a labor, but they also get to export the vehicles made there and avoid paying duty. So there's two things.
Including to Europe, which I think is a sticking point for the U.S.
And yeah, so long term, probably having free trade with the U.S. and Europe would also help. But that's another reason why people are going there. So it's a pretty complex issue.
Yeah, but when it comes to another U.S. demand, a higher North American car content, that would benefit Magna. So does that mean that you support it?
Well, in theory, it would benefit us because we are the biggest supplier by a fairly large margin in North America. The issue is if it gets too high and car makers say it's too costly, too administrative, they can't meet it, that means they'll say, well, we'll just make the vehicles offshore and ship them in. And then it would be bad for everybody. So I know the intent is there, but there's a fine line to how high you make that regional value content. And again, I think that's understood. So there's a lot of detailed discussions have to happen to get this right.
Also, at what point do you realize that these firms will have to actually transfer those higher costs to consumers?
Well, I think they're going to have to transfer them immediately. One car maker may say we're going to delay it, but if the price goes up, this is a competitive market, then that means it's going to end up with the end consumer. I mean, we can't eat it. The car companies can't eat it. To the extent it gets too competitive, people won't buy cars. Then this could be really bad if we don't get it right. And there's lots of discussions going on. I think a lot of smart people are involved here. Chrystia Freeland and Steve Rahul from Canada understand the issues. They've been doing a great job. So it'll be very interesting to see what happens.
It was also interesting to see the president using this meeting, which the automakers are hoping are about fuel efficiency standards and a national plan, to say, well, I want you to bring your manufacturing back. You fly on the wall, you're in that room. How persuasive is it these days? Tax reform makes it very attractive to operate in America. Obviously, politically, you gain some capital. Do you think he can sell the big auto producers globally to locate in America?
I think that has some influence, but at the end of the day, it's a combination of pressure, incentives, reducing the cost. But the auto industry is very, very competitive, and there's very good companies emerging in places like China. So if we can get NAFTA right and make sure all three countries, it's a win-win-win to a certain extent, then what we really need to worry about is all the vehicles made in Asia being shipped over here. That is a really big competitive issue, and that has to be in their mind. We can fight internally. NAFTA has been pretty good for the automotive industry, except the assembly plants moving to Mexico. They need to make sure when they do whatever they do, we have good trade balance and rules with other countries.
The key issue being discussed today between President Trump and auto executives is the fuel efficiency standards, and the National Highway Traffic Safety Administration actually favoring freezing the U.S. fuel efficiency standards at 2020 levels. What do you think, and what's your view?
Well, everybody's got their own opinion. I do believe we need to be looking at the impacts of global warming. We have to look at what is the cost going to be, what's the right time to get there, and we can do whatever the rule is going to be in North America. We also need to look at what's happening in places like China and places like Europe, because most of the vehicles and the powertrains are global. So I think to the extent that the consumers want to buy trucks and SUVs, if you have to hit targets, then they're going to have to make cars that they lose money on, and nobody wants to buy. So again, it's a complex issue that we have to make sure we get the right people looking at it.
Don, we saw this historic move by Ford out of its sedan line, out of the cars, and really doubling down on trucks and SUVs. What are some of the trends? You've got to watch this closely because you're feeding right into these. First of all, you were making parts for some of those cars that are being discontinued. Is this an ongoing trend that we'll see?
No, I'm not surprised to see that. I think the automakers have come to the conclusion, probably rightly so, that they don't necessarily just have to have market share globally. They have to make money, and they'll make the tough decisions they have to. And I would be doing the same thing as well. They're doing it because they have to produce cars the public want to buy. And that's exactly what they're doing. And it's getting very costly to make small cars in North America, so they probably make them elsewhere. Again, that's why I think the moves the U.S. government is doing to make it less costly to make cars is good. Canada has to learn from that and make sure we don't do the exact opposite. But I'm not really surprised that any company would look at what's the end consumer want to buy and make it for them.
Make that. Don, great to have you here.
Thank you. Appreciate it.
Don Walker is Magnus CEO. Coming up, U.S. stocks are mixed as the dollar sees a slip. We'll have market insight with George Maris, Janice Henderson, co-head of U.S. equities, next. This is Bloomberg. is Bloomberg Markets. I'm Amanda Lang in Toronto.
And I'm Sherry Yan in New York. Stocks trading in the U.S. mixed as the dollar slips slightly. Joining us now is George Maris, Janice Henderson, co-head of U.S. equities. Great to have you with us. So one sector that's very interesting is healthcare and pharma stocks. They're still gaining ground despite the fact that President Trump will announce some plan on lowering drug prices. So what's going on?
So I think what's happened is the industry or the investment community's known that Trump was going to go after, the elevated pricing in the pharmaceutical industry. That was a part of his campaign speech. He reiterated that at his State of the Union. So we knew this was going to come under attack. He clearly wants to lower out-of-pocket costs. He wants to do so especially for seniors, and he wants to introduce competition. What we've seen so far today, and it's clearly just a few minutes before his speech, are consistent with that. So I think just getting past that is going to be a sigh of relief to the investment community. We know what's out there, and it's not going to be worse than we anticipated.
And generally, earnings have been pretty good in the U.S. So when we are seeing these sell-offs here in the markets on and off, is that a sign that people are worried that this may be over, that we're done with the